I'm your lovely host, Ferris. This is our less lovely host, Ben, but still lovely.
So when do we do this?
Every Monday, 3:30 Central.
3:30-ish Central Time, it seems like. Now we're a couple minutes late. I'm going to blame this slacker over here.
It's always my fault.
I mean, somebody was trying to do some work. This guy over here was talking, But anyway, what are we talking about today, man?
We are talking about multifamily investing market update.
Okay. So this is a fun one. So we're going to get right into this. But once again, welcome everybody. We do this every Monday, 3:30 p.m. Central Standard Time.
Not
so check
AM,
us out.
not AM.
Not AM. And if you guys have questions, drop them in the comment section. Give us a like, give us a share. We love it to be interactive. If you guys have any topics that you want us to cover, please drop those in the comments as well. Shannon will pick that up. We'll get them into the queue. Doesn't necessarily have to be multifamily. It could be real estate, entrepreneurial, tech, whatever you want to talk about, right? So we're going to hop right into this. All right, so what are the questions that we got, right? What do you see in today's market regarding competition, pricing, and deal flow?
It is definitely getting competitive. I mean,
competitive.
It was kind of quiet. Honestly, I thought January would be busier than it was.
Yeah.
Right, we kind of come out of the COVID slump, expected things to be hotter because December was starting to heat up. I expected January to be really hot. For those of you that don't know, usually in January is whenever NMHC, the big multifamily conference, happens.
That's where all the brokers go.
That's where all the brokers go, and that's where they list deals. So usually January you see a big influx. Well, January was actually quiet.
Yep.
But February and March, things really heated up, and there's just a ton of deals on the market. And so I like whenever there's too much deals on the market because demand's already high. So if you increase the supply, usually you can find a deal or two that makes sense. Right?
Sometimes.
And so, sometimes, right? And so ultimately, I mean, it's hot out there, right? Cap rates have compressed in every single market we've looked at.
Yeah.
Right? Debt is cheap. It's continuing to be cheap. And there's just a lot of demand, right? There's a lot of money wanting to get into multifamily. So,
and I think that there's a fair amount of deal flow, right? There's not. I wouldn't say it's a lot. There was obviously a little bit more. I think in February, March, it's kind of trickled off a little bit since then. But the demand for that supply is gone through the roof, right?
Yeah,
so
if anyone has a good deal and you needed to flow the deal somewhere, you flow it to us. Let us know.
We do co-GP. We're
happy to get any deal across the finish line. Anything from $5 to $70 million, we are very interested in.
Absolutely, right? So what does that do to pricing though, man?
That to pricing, I mean, really pushes prices down, right?
No,
Cap rates compress, valuations go up, right? And basically, prices are going up. So
yeah. So cap rates, remember folks, cap rates go down, valuations and prices go up. All right. So that's how this works. It's inverse to each other. So cap rates have been compressing. Two different reasons why. We've talked about this on the show before, right? But debt is cheap, very, very cheap in comparison to historical numbers, right? You can still get an all-in coupon at 3.5% fixed rate for 10 to 15 years. People haven't ever done that, And on top of that, the Fed and just in general, there's just the whole economy is awash with money. And people are looking to where's the best yield for that capital. And multifamily was fairly resilient because of COVID, right? We did have some challenges, obviously still ongoing with the eviction moratoriums. But in comparison to, say, hospitality or some retail or some office, we're looking pretty good. And so you're having even more people flow into the multifamily market than were there even before that. So that is why pricing is going up, right? And cap rates are going down. So number two, what multifamily asset class is performing well? So I'm going to go, this is just our own personal opinion, right? Obviously everybody might have their own, and if you do have a comment, please drop it in the comment section if you would, right? We're seeing it's kind of more B, than maybe an A than a C, right? And I think it depends on
I'll say this, because cap rates have compressed, right, in all asset classes, the problem is the spread between asset classes has not changed that significantly, right? And what I mean by that is the spread between an A and a C is very small, right? And ultimately, I'm a big believer in why not.
All right, so let's back up there. Let's maybe kind of, because for some folks that are just tuning in, right? So, you're going to have cap rates, right? So let's just use round numbers. So for example, a C might be a 5.
Ben was a C student.
A B might be 4.8, and an A might be 4.6. Right, so there's not a big divergence between those three, right?
Yeah, and so I'm a big believer personally. Is hey, I'd rather pay up a little bit more and get a deal that's 20, 30, 40 years newer than try to save a couple of bucks and get something that's significantly older.
Yeah.
That's just ultimately my philosophy. And so right now in this kind of weird market where there's a lot of demand on the C, I think we're, especially in the apartment market like Houston, we're targeting maybe a different asset class than what we traditionally do.
Right? Because there is parts, of the country where it's literally, there's no differentiation between those asset classes, right? And one thing that we saw in Atlanta, we were out there last week, right, is that Bs and Cs are actually lower cap rates than an A, right? And people are gonna be like, wait, that's kind of, what does that mean? How's that possible, right? It's because, you're seeing some level of rent growth with the Bs and the Cs right now, and there's still some deals that have some meat on the bone. So the market is pricing those more competitively than an A where there's concessions sometimes, or rent growth might not be as robust as say a B or C. Now that's Atlanta, right? Each market is different, right? But what we're seeing is that instead of there's this big gap like there used to be traditionally, there's very little gap, if any, in some of these markets, right? So, I'm going to go out there on a limb and say probably a B class multifamily is kind of where you're going to probably have the best returns through COVID, right? Now, what's going to happen in the next 6 to 12 months? Nobody has a crystal ball, right? But that's what happened, probably performed the best through COVID. How has your investing strategy changed in 2021? Well, you just kind of
went on one of them, right? Looking at other deals that we also, honestly, it's hard to find a true value add, right? So changing that dynamic and looking at deals differently, right? Maybe it's not about just putting money into the interior. It's about what else can we do to kind of juice those deals, right?
Yeah,
you
gotta
about
be creative.
putting in, covered parking, some of these other things that are lower revenue things, but sometimes the only thing that you actually can do to a property.
Yeah, there's only so much lipstick on a pig that you can do, folks. So you have to really get creative. And what's the story here on these Class C deals, right? And like Farrah said, some of the stuff might not yield a tremendous amount of return on investment, but it's better than doing nothing, right? And so and sometimes the interiors might have already been upgraded, and so you have to look through these other strategies and the other parts of the property that you can increase the valuation there, right? I would say overall, how has our investing strategy changed? I think two things, right? We are looking at newer deals in better markets, right? We're not shying away completely from secondary or tertiary, and we're not shying away from Class C. And I think the other thing that we've kind of tried to be good about, we were just looking at one earlier, but the numbers really have to work, is anything that was built in the 60s. I think a lot of this stuff is coming up on its useful life, and you have to be very, very careful, right? Plumbing, electrical, mechanical systems are just going to start failing, and you're not going to get very little return on investment, if at all, replacing all the plumbing on a property, right? People just expect that stuff to work. Right, they're not going to pay you an extra $50 a month because the plumbing works, or that you had replaced all the plumbing on the property. Nobody cares, and even on the sales side, nobody really cares. You're gonna say, oh, you replaced the plumbing, yeah, that sucks for you that you actually had to bite that bullet. But I'm not necessarily going to give you an extra $5 million because you did that.
Yeah.
Right, maybe you get a little bit of pop, but not really. So that's kind of somewhat of how we're looking at the market and some of the things that have changed in 2021, and it will continue to evolve. I think the one thing that we're good at is we're a boutique firm, so we can be nimble and we can kind of fluctuate depending on some of the strategies that we're seeing kind of be successful in the market. So that will continue to evolve. What do we see in terms of rent growth, occupancy, and collections? All right. So rent growth, I'm seeing that there was some pent up demand, even in the Cs, right? Now, this is once again dependent on the submarket, folks. Real estate is hyper local, so I'm not making a blanket statement across the United States here. But there is some rent growth potential in the markets that we invest in, which is Texas and Georgia, right? Florida as well. Occupancy, for the most part, has stayed fairly strong, right? In the 90s.
Occupancy has been good, and we are starting to see that rent growth happen. We're starting to get those pushes, those renewals, and so we think. Is inflation going to happen? Maybe, probably, right?
I think it's already happening.
I think properties will naturally start to collect more as things kind of sizzle from COVID, right? As the economy picks back up and people start to move forward. So,
and I think that goes into collections, right? Which was the tail end of this question, right? Collections is in a lot of ways tied directly to where we're at with these eviction moratoriums. And I think that is starting to open up a little bit. I think it's going to be contested and probably go all the way up to the Supreme Court, as to, the legality of that CDC declaration. But for right now, a lot of the local, eviction courts are staying dormant, or they're only taking the worst of the worst. Right, and they're pretty much saying, if you really do have a CDC declaration, we ain't doing anything. You're SOL.
So Justice Suttles, what would you think is the right ruling on the CDC declaration?
Oh, I don't want to get into politics, right? I look at it from both sides. There should be a happy medium, right? And I think in a lot of ways, they should be taking care of, the people that are truly affected. I get it, right? But we should be more involved as landlords in that process and that legislation, and not look at us as the bad part of this transaction, right? We all have families that we need to take care of. We have employees that we employ at the properties. We're not trying to create a slumlord type situation, right? So if we don't have any money that gets put into these properties, right, what do you think is going to happen to these people's housing? It's going to go downhill.
Doesn't want to get into the politics by giving a very political, neutral answer.
That was a very neutral answer. Okay, I should have been a politician, right? Maybe a lawyer, I don't know. But, so that's I think there's a happy medium. We haven't reached the happy medium. Let me just put it that way, right? And people can make a determination on which way I think we're actually at in the market right now. So, what's the latest in cap rates? We talked about this a little bit.
Yeah, we talked about that. I mean, man, everything across the board we're seeing is in like low, basically 4s to 5s.
Yes.
Right? There's no such thing as a 6 cap, whether you're secondary, tertiary. I mean, I really maybe tertiary C-class properties, right?
But something that's got some real hair on it.
We're seeing,
right?
And honestly, C-class properties with value add are going for 3 caps, right? 3.5, 3 3/4. It's kind of crazy. So, pick your deals very carefully.
Yeah, I think that you have to realize that some of the reason why is we go back to the earlier statement, right? Debt is cheap, equity is all over the place, so that's going to drive demand. Demand is going to drive cap rates down, pricing up. This is just how this works, right? There's a big supply and demand. People need to understand how economics works, right? To really get the reason why cap rates and valuations are where they are. Right, but if you're getting into the market, right, and you're thinking you're going to go buy a 6, 7, 8 cap, good luck, right? It's just not going to happen. And so you need to be realistic.
If you do find an 8 cap, come talk to me and I'll pay you a 7 cap for it.
There you go.
So with that said, Mondays, we do this every Monday at 3:30 Central. Usually we kind of spend the first 20 minutes talking about different topics. Today we're talking about the multifamily market update. Yep. If you have comments, questions, go ahead and leave it, and we'll basically do Q&A at the last 10 minutes. And so with that said, before we continue, Ben, let's see a few comments, questions. John Montero, our buddy, says insurance premiums are more of an issue on older properties too. Absolutely right. Right, with newer assets, insurance is cheaper, so you get other natural things that come with it. Yep. So definitely something to check out. Jefferson Gon says, Buenos tardes, amigos. What's up? How's it going?
Hey, buddy.
Rod says, hello, everyone.
Hey.
Amanda Larson says, if interest rates go up, would you expect cap rates to be pushed back up as well? That is a fantastic question.
No, and thank you for bringing that up.
I think about that often, right? So if interest rates go up, naturally interest rates are a leading indicator to cap rates. Interest rates go up, cap rates go up. But you also have inflation.
It's a big but.
But you have inflation is the other piece to kind of really think about. Right, and so now it gets kind of weird because inflation is a leading indicator to interest rates going up, which is a leading indicator to cap rates. But with inflation, right, your properties generate more money, right? And so while cap rates may compress, your valuation may not have actually gone down. While cap rates may go up, your valuation may not have gone down because you've generated more money from that property, right? And so it depends on kind of how you look at it. So is it that I'm getting inflation, therefore my costs have gone up, my insurance, my taxes? Or is it just my income has gone up? And so therefore I'm actually making more cash flow, which is offsetting the compression, right? I don't know what the right answer is. I think about that often.
And John Montero's our friend that's the economics major, right? Maybe you could chime in here a little bit too, buddy. But, that was a great question. And I think that there's another component that needs to be kind of brought into the equation, and that's demand.
Yep.
There is so much demand for multifamily, way more than was 12 months ago, right? Because I go back to my earlier statement where you have hospitality guys and gals, you have people from retail, from office, from some of these other asset classes that just got annihilated during COVID. They still have capital to deploy. So they're going into multifamily. So that's essentially skewing.
Yeah, no, there are people that are looking
cap rates down
for much less return, right? So maybe 5 years ago, people would not get into an apartment if it wasn't going to generate 10% cash on cash. right? Nowadays, there's some groups, they're looking for 4% cash on cash. So their spread, right, is 6% less that they can do. So even if interest rates went up 6% difference, they're still where they were 5 years, right? I mean, so I agree with that point too, right? They're just, and I think ultimately with the amount of money that get pumped into the economy, I'm a big believer that money is going to trickle up and it's going to look for investments down.
Yeah, so. And I think the other thing too, right? Not only the equity piece, but
And John agrees, demand will override slight changes in interest rates.
Yeah, and I go back to I'm not a believer that interest rates are going to go up anytime soon.
No, I don't know.
They might trickle up a little bit, right? But what's ended up happening is that the bridge markets kind of came in too, right? And they've helped, where Fannie and Freddie started kind of pulling back a little bit. Who knows why? Maybe because they thought that they were the only game in town, or maybe because they were a little bit squeamish about where the economy was going. But Bridge came in right on top of them, and they've kept their coupons pretty low too, right? So interest rates, we're on average, people are thinking, oh, well, Fannie and Freddie are traditionally lower, in terms of their interest rates than Bridge debt was. Traditionally, that was how it was. Now, not necessarily this. They're pretty much the same, right? You could get a 3.5 coupon from a Bridge lender right now, whereas maybe you're right there, maybe even a little bit higher with a Fannie or Freddie loan. So something to kind of keep in mind too, right? People are clamoring for that business, so they're keeping interest rates low too, right? I know there's a lot of other metrics, and but at the end of the day, I don't see them going up. So, what markets do you see rising? I'd say which markets do we not see rising is probably the question here.
I mean, I think Houston, all eyes on Houston, all eyes on Texas, first of all. All the markets in Texas are on fire, right? There's so much demand, so much interest, right? But even Houston, which has kind of been in the backseat the past couple of years, I'm starting to see a lot more activity in Houston, right? I mean, it is the number one job growth city. So if you're interested in Houston, wait about a year till we buy what we can. Then we're happy to kind of have that conversation. But ultimately, there's a lot of interest in Texas.
No, there is.
All the markets are in Texas have a lot of demand.
And in Florida. And then you could go, obviously, the Carolinas, and you could go out to Arizona, right? Those markets are probably the hottest ones right now. And I would say that I don't see those going down at all. If anything, they're going to continue to rise, right? Whereas some of the markets that might be a little bit more depressed are ones that are, pretty much common sense, right? On the coast, New York, LA, San Francisco. Not to say that those won't bounce back. They obviously have good, long-term, projections there. But for the time being, there's probably going to be some short-term pain for those landlords, and a lot of them are looking to deploy capital into other parts of the country too. So not only are you having to compete with the hotel people that are getting into multifamily, you're also having to compete to people that would have maybe traditionally kept all their money in New York, which is what we're seeing in Atlanta. Now all the New York money is coming down to Atlanta and into Florida. So you have just this, once again, increase in demand that you're having to keep up with, and that's also all ships rise with the tide. That's increasing valuations in those markets, right? So where do you see the multifamily market going? I think it's strong for at least the next 5 to 10 years. We have an affordability problem in this country, and I think that they're not building Class C or Class B properties anymore. Everybody that's building, Class A, for the most part, now we've gotten lucky with some of the partnerships that we've done where we've kept costs low, so we can have some affordable rent. But for the most part, you're getting a Class A plus that's $2,000.
Developing is getting more expensive, and so now if A class build that brand new is going to cost you $180 a foot.
Yeah.
Well, now paying, for that C property that you might have paid $120 a foot, paying now $130, $140 sounds a lot more attractive, right? It's by cost going up, you're increasing that spread, and so this thing is going to rubber band over this way. So
yeah, so ultimately, I think there's going to still be some opportunities for quite some time, and I maybe even into the future. I think there's a lot of renters by preference these days. People that were just going to traditionally always rent. And I think that's going to be ongoing. And then there's going to be people that are getting priced out of the single family market because either A, their credit's not there, or B, they're just getting priced out in general. They maybe even have the down payment or they have the credit, but they just can't afford the houses. So they're once again going to fall back to renting an apartment. And on top of all the other things that we've talked about over the years, right? Boomers are downsizing, and kids coming out of college are waiting longer to get into houses, right? So all of that continues. Now it's just a matter of where is the multifamily, right? And what type of style of multifamily is going to be big in the future. but I think multifamily as a whole is going to be on fire.
I agree.
You know,
So let's see. So Monday Mondays, we do this every Monday, 3:30 Central. We are talking about multifamily market updates. So if you have comments, questions, go ahead and leave it. Usually spend the first 20 minutes presenting, then 10 minutes Q&A.
This is
we
Q&A
are in
time.
that Q&A section. So going through a few more of the comments. John says also short-term interest rates have not moved up. Not at all. If you all don't know what the SOFR is and you have not looked at it, go look at it because it's pretty much zero, right? So that's what floating rates are based on. So new floating rates are based on.
Well, that's why Freddie floaters are so
attractive
in
right now.
demand right
Our
now,
most recent
right?
deal was a
'Cause
Freddie
you're-
floater, and we are excited about it.
Yeah, I mean, our all-in coupon is what, 2.8?
I think it's 0.87, but yeah.
Oh, sorry, 2.87.
So definitely, be aware of that. So yeah, I totally agree, John. Brandon Gordon says Mondays are always lit. Thank you. Appreciate that.
And if you guys want, if you guys want to hear about something, you want us to talk about a topic, let us know. We're open to that.
Talk about anything. It does not have to be about what we presented today.
No, absolutely not. Yeah. And that goes for questions too. Just go ahead and lob them in there. Let us know. We'll kind of go from there. Otherwise,
Let's keep going.
I'm going to shamelessly plug a few things.
Let's do
it.
Wait, we got one more question. As a new investor to multifamily, this demand means it's so prudent to vet operators. Totally agree.
Absolutely.
Know who you're investing with. Understand their track record, what they're doing. Are they transparent or not? That's the truth of it. And that goes for any investment you ever invest in.
Absolutely.
Really, don't just lob your money into some random thing.
No,
with
I
random
think
people.
I'm a big proponent of you're betting on the jockey, not the horse, right? So, who's going to be the most successful in the next 10 years is going to be the operator, right? I think people are going to stumble into some appreciation, maybe stumble into some plays, but you have to have the right operator and teams there to be able to, be successful. So, all right, moving along here. Sorry, my phone is going off. I can't believe that would actually override what we're doing here. But anyway, I'm getting off track. So I'm going to shamelessly plug our YouTube channel because I want you guys to subscribe. This is where we're going to have all of these types of programs, including a lot more, all of our webinars, everything that we've got going on. So check us out, www.youtube.com/c/disruptequity. We're going to have our next Texas Multifamily Masters meetup, which we just had last week, where Anton Matley shares a ton of good data points, right, on the economy. He does a great job of kind of articulating that. We've got those types of things on there, as well as these, as well as other shows and content that we're putting out there. It's all going to be on our YouTube channel, so please check us out there. MFIN, I wouldn't get through a Money Monday without talking about it because we're getting close to selling out here. So I want people to get their tickets, right? July 24th, Miami, Florida. Come on, who doesn't want to go to Miami in July?
Absolutely. So definitely go check it out. We've gotten a lot of interest. Should be a really good show.
Yeah, so get your $100 off coupon by putting in DISRUPT in the coupon code at checkout. A lot of great speakers. We're still lining up the panelists. But rest assured, anybody that's been there knows that we're going to put on a good show at a nice place, and ultimately, it's all about the relationships that you're going to get from going to these types of events. Let's get back out there, folks. Right? It's been a long 12 months due to COVID. We're starting to do some events, and this is how half the relationships are made is through the networking that goes along with these. Right? So mfinvestornetwork.com. Check it out there. What are we talking about next week, man?
How and where to invest as a young investor that is just starting out.
Okay.
So if you're old, please don't participate on that. No, I'm kidding. You're all welcome. Young does not mean age. It means new is maybe a better way to look at it. So definitely come check it out.
Yeah, no, definitely. We're going to, some strategies that maybe you can get yourself into a deal, right? Even if you're young or new, right? I'm fine. We're going to go through everything. Right? How do you start off? Because, I think it's the most important thing to understand early on. And I wish everybody that looks back on their career says, I wish I would have started earlier. I wish I would have bought more before.
Totally agree.
Yeah.
So let's see. So going through a few last comments, questions. Money Monday, we do this every Monday, 3:30 Central. Trevor says, looking forward to Miami. Look forward to seeing you there as well.
Thank you, sir. Thank you.
And then John Montero again says, supply, housing versus demand, population growth imbalance. Absolutely, right? There's just costs is going up, plus populations are still growing, especially in Texas, right?
Yeah.
That's just going to naturally lead to appreciation, right? And while we're not really appreciation investors, right, it's always nice to get that gravy on a deal.
I'll take the icing on the cake, my friend.
Absolutely.
And eat it too.
So with that said, Money Mondays, every Monday, 3:30 Central. We're going to wrap it up. If anyone has any more comments, questions, speak now or forever hold your peace.
So what are we talking about next week? One more time.
How and where to invest as a young investor just starting out.
All right.
Thank you all, and